Hi, everyone. Tracy here again from Student Support Services. Another video for you today. And today I want to talk to you about loans. Okay. So a lot of you are probably familiar with loans if you have a student loan or if you've bought a car and you have a car loan. So today I want to give you a little bit of information about what types of loans there are, how you go about getting a loan, how you pay for your loan, all sorts of information like that. Okay, so basically there are 4 types of loans that you can get. So I have a list here. First one is a personal loan. Now, a personal loan is if you want to, say, borrow money to go on a vacation, or you need to borrow money to redo something in your home, or you want to borrow money to pay off some other sort of debt. That is a personal loan. Then you can get a loan to buy a house. That has a special name. That's called a mortgage. Student loan, you're probably familiar with that. That's to help pay for college. And then an auto loan if you want to try to buy some sort of a vehicle. Every loan has 3 basic parts to it. There's the interest rate, there's the security component, which would be if you have a down payment or if you have to do something to show them that you are serious about getting this loan, some sort of well, we'll talk about that a little bit more in a minute. And then the term of the loan. Okay, so when you are talking about loans, there's going to be a lot of terminology, a lot of words that are talked about, and I want to just run through some of the most important ones. So principal, how much money are you trying to borrow? That's the principal. Term, how long are you going to have this loan for? Is it for 12 months? Is it for 4 years? Is it for 30 years? That's the term of the loan. Interest rate, that's the percentage. How much interest are you paying? Do you have a 5% interest rate? Do you have a 10% interest rate? Do you have a 7.2% interest rate? And then fees. There are a lot of fees associated with getting different types of loans. There's an application fee. There might be a processing fee. If you get a house, there's a title fee. There can be late payment fees. Some loans will even have a prepayment fee, and we're going to talk about prepayment a little bit later. Okay, now if you want to get a loan, you can't simply go to a bank or to a lender of some sort and say, okay, I'd like a loan. They're going to make sure that you qualify for that loan. And a few things they're going to look at in order to make that decision are listed here. First one, credit score. Okay, we've talked about credit score in some of our other videos, and if you're not sure what a credit score is, you can go back and look at those videos. But a credit score basically is a summary of how good are you with your money. Okay, they're going to look at your income. If you want to buy a house and you want to borrow $300,000, they're going to look and see how much money you make. And if you only make $50,000 a year, they're going to say, no, that doesn't make sense for us to give you $300,000 if you're not making enough money to pay that back. Then they're going to look at something that they call your debt to income ratio. So they're going to look at how much debt do you already have? Do you already have a bunch of loans? Do you have a bunch of student loan debt? Do you have a car loan? Do you already have one mortgage? And then they're going to compare that to how much income you have. And if they see that ratio as, well, you have this much debt and you only make this much money, then they might be less likely to give you a loan. But if you have less debt and a larger income, then they might be like, oh yeah, you seem like a good person to give a loan to. So they're not just looking at how much money you make, but they're looking at how much debt you have compared to how much money you make. Okay. The next thing on the list is collateral. Okay. Collateral means what are you willing to put down in order to say, yes, I'm going to pay this back. So for a house, a lot of times that's the down payment. I will give you $20,000 and then you will give me this loan. Or it might be in terms of like, I have this land or I have this business and I'm going to sign something that says, if I don't pay back my loan, then this becomes yours. Or sometimes that's called a secured loan, where I'm promising you that I will pay this loan back. If I don't, you get this other thing that I have. Okay. Then the last thing on my list is co-signing. They might look at all of these things and say, you know, you're kind of on the line. You might qualify for a loan and you might not. But if you could get someone to co-sign for you, we'll give you the loan. Now, what that means is they want somebody else to come and say, you know what? I think this person is going to pay this loan back, but if they don't, then I will pay for the loan. Excuse me. So a lot of times that might be a parent, that might be, some other adult that, they find responsible, that might be a spouse. So if they say you need a co-signer, that means you have to find someone who's going to step up and say, yep, if this person doesn't pay for the loan, I will pay for the loan. Okay. Another thing that's important when you're talking about a loan is to know that sometimes you have the option of refinancing your loan. And when we talk about refinancing a loan, there's a couple reasons you would want to do that. Okay. Sometimes you can refinance a loan to get a lower interest rate. Sometimes you can refinance a loan to get a shorter term. Sometimes you can do both at the same time. And overall, the goal to refinancing a loan is to save money on the interest that you pay. Now, for example, this is something that my husband and I have done. When we bought our first house, we had an interest rate of 7.2% and a term of 30 years. Now, when we bought that house, 7.2% was a really good interest rate. But as time went by, the interest rate started dropping further and further and further, and it got to a point where we could get an interest rate of less than 5%. Now, that would make a huge difference in the amount of interest that we were going to pay. And by lowering our interest rate, we were actually able to shorten the length of our loan from 30 to 15 years because of the difference in the payments. So by refinancing our loan down to that lower interest rate for a shorter term, we were able to save over $50,000 on interest that we were paying. Okay, so that makes a huge difference in the longevity of paying off that loan and how much money you're going to pay. What you want to make sure of is that when you redo this loan, you have to pay all those fees again. So you have to pay the application fee, you have to pay the processing fee. So you want to make sure that you talk to the people at the bank and say, okay, what fees am I going to pay? How much is that going to cost? And is it going to be worth the money that you're saving on the loan to take on those extra fees? Okay, so a lot of people think that when they make a loan payment, that money goes directly towards paying off the loan or towards what we call the principal. And that's not true. Every loan payment is broken into two parts, the part that goes towards the principal and the part that goes towards the interest. Okay, so here's just an example of 3 payments. And what you see here, it's called an amortization schedule, which basically shows how your payment is broken apart. So here are 3 payments for a loan that started out at $13,000. Okay, each payment is $251.33. And you can see that what they do is they figure out, okay, for 1 month, how much interest do you owe? So for the month of June, you owe $65 in interest. So they take that $65 right off the top, and then whatever's left goes towards the balance. Then the next month in July, they figure out, okay, how much interest do you owe on that balance? And you can see the interest that month is $64.07. So they take that off your payment, whatever's left goes towards the balance. And then they keep doing that. So you can see by the numbers that I have at the top, that after 3 months of making this payment, you have paid $753.99, but your loan balance has gone down by $561.78. So in 3 months, you've paid almost $200 in interest. That's just in 3 months. $200 has gone to interest. So if you expand that out, say over a year, you're looking at paying almost $600 in interest over just 1 year. Okay. And then this is going to take you more than a year to pay off. So the longer you're paying this loan, the more of your money that goes to interest, which is when we come to that idea of prepaying your loan. Okay. Prepaying can happen a lot of different ways, but the easiest way is that each time you make a payment, just add a little bit extra money. So if you go back to this, if we go back to this, if your payment is $251.33, maybe instead you pay $260 or $275. You just send in a little bit more money. And what happens then is that extra money will be applied to the principal. Okay, the amount of interest you owe isn't going to change. So whatever money is left over goes to the principal. And what that does then is it will reduce the balance of your loan quicker, which will then shorten the length of your loan and will then have you paying less total interest. Okay. What you want to do though is make sure that this is something your lender allows you to do. Not every place is going to do that. So you would want to check when you get the loan and say, do you allow prepayment? Is there a penalty for prepayment? If they don't allow prepayment, you might want to check someplace else, because prepayment is a great way to help pay off your loan faster. Okay. If you have any other questions about loans, as always, please check with us. Send me an email, send me a message, and I would be happy to help you. If not, thanks for stopping in and view the video. Check out It Makes Sense. There's a ton of information there. They're always happy to help. Thanks a lot.